So like I said, when you deal with international valuation standard, you are looking at your syllabus cover four key standards. The first one is IVS, International Valuation Standard 200, that deals with business and business interests. International Valuation Standard 410 that deals with intangible assets. International Valuation Standard 410 that deals with development property. And International Valuation Standard 500 that deals with financial instruments. Now, for IVS 200, evaluation of business interest looking at valuing the entire business, which includes shareholding and liability. There are four levels of business interest. The enterprise value. How do we estimate the enterprise value? It is the total value of equity plus total value of debt minus cost, cash, and cash equivalent. Mr. Kayode, I'm going over some of these points again.
Yes,
so that in the recording you can be able to review it quickly. So,
yes,
like I said, there are four levels of business interest valuation, which is covered by the first IVS 200. We have the enterprise value, the total invested capital value. The total invested capital value is calculated as net asset value of the company. If you remember, net asset is the total asset minus total current liability. Is that clear? The next one is the operating value, which is the total value of the operating operation of the business minus value of non-operating asset and liability. Number 4, which is the last one, is the equity value, and we are looking at the total market value of equity. You take the total shares here, total shares of the company, and you multiply by the market price per share. So here you just take the total shares. We've done that a lot. Multiply by the total market shares of the company. Now, valuation approach. We know two key valuation approach, which is the market approach and the income approach. The market approach, there are two levels of calculating the market approach. We use the stock market value in a country that have the stock market, or the acquisition value, how much is that asset acquired, or prior transaction value, where we look at how much was the asset acquired previously. Are we together, sir? So the next one is the income approach. The income approach, we have different methods of income approach, but the key among them is most the net present value or the free cash flow value. We are going to see this in detail. If you look at IVS 210, intangible asset, I have mentioned earlier that it is difficult to estimate a market value basis for intangible asset because of its nature. Now, we use the income approach most here, and the most common method for valuing intangible asset using the income method can be classified into 4. The first one is the excess earning method. The excess earning method, we are looking at the earnings here, that means revenue minus expenditure multiplied by WACC. But if there is any return on not current asset, please deduct it, only when it is given. If you look at this example, you will see the calculation there where we take revenue, 5 million, operating expense, 3 million, return from non-current asset, 15%, WACC is 10% given. The non-current asset value is 20 million. So we now calculate the value of intangible asset using the income approach. We now take the revenue, 5 million, less operating expense of 3 million. Then we reduce the return from non-current asset, 5 million, 5% of 20 million. Then we now have 1 million, and then we discount it at 10% because we are looking at a 1-year forecast. The second method is the relief from royalty method. Please get this right. The first method I gave is the excess earning method. The second method is relief from royalty method, relief from royalty method, is that a hypothetical royalty is estimated to be paid for the intangible asset. So we'll use the same thing, look at it, but we estimate that we may be paying some royalty for the intangible asset that we are using. In this scenario, for example, I changed this to 30% earlier. Revenue is 10 million, estimated royalty, hypothetically means is postulation. 30%, what is 10%? So calculate the value of intangible asset using, for the next 5 years, using the relief from royalty method, RFRM method. Solution, we take revenue of 10 million with less royalty payment of 3 million, which is 10% of 10 million. Then we have 7 million. We now discount it 10%. Please, this is annuity factor. 10% year 5, because the examiner say year 5. We now have value of intangible asset at 26,537,000. Then we go to method number 3 for estimating intangible asset under the income approach. It's called with or without method, WWM. With or without method, WWM. Very interesting method. The method says that we should just look for the difference between the value of the business if intangible asset is used minus the value of the business without intangible asset. So value of the business with intangible asset minus value of the business without intangible asset. I look at this example. Bratton estimated to generate 12 million profit if royalty is used. And the current profit is 6.5. So Bratton is not using royalty. They are estimating to generate 12 million if they use royalty. So the value of the company, they say, what will be the value of intangible asset using with or without method, WWM. We now look at the value of intangible asset will be 12 million minus 6.5 million. 12 million with intangible assets and 6.5 million without. That's the value without intangible asset. We now have 5.5 million. The last method is the greenfield method. I have to overview this because it's very key. And my spirit tells me that this is what may be featuring in the exam, which is IVS 210. May be the one you should expect in this exam. So the greenfield method, very easy. You see the value of intangible asset is determined by using the cash flow projection that assume the only asset of the entity is intangible asset. Assume the only asset of the entity is intangible asset. So whatever value we arrive at is the value of intangible asset. Now let's go to the next one, sir, if you are there.
Yes, sir.
Let's go to the next one.
Okay, sir.
Okay, the next one we're looking at here is, I think that's number, okay, the next IVS is 410, isn't it? Development property.
Yes.
I think that should be our, is that the last IVS? International Valuation Standard, 410,
No.
this with development property. We still have one more, Abi?
Yes.
Development property. Now, development property, for the purpose of the calculation, development property are defined as interest where development delivers the highest and best use. I repeat, development property are defined as interest where development deliver the highest and the best use. That means where improvement will come in from the progress of development of a particular asset. Now, for this particular purpose, let me write the definition down for you. Definition. So are you there?
Yes, sir.
Okay. It's defined as interest where redevelopment sorry, where is development? I was trying to do something. Delivers the highest and best use. Best use. Mr. Kayode, are you there?
Yes, sir.
Now, like I said, where improvement are either being contemplated or are in progress at the valuation date of the asset, we look at the highest and best use value of the development interest. We use that to value the property. There are two main approaches for estimating development property value. There are two main approaches. The first one is a market approach. I've explained this before, so I won't go into it deeper again. Number one is a market approach. I explained you the level of the market approach before. And then number two is a residual approach. Residual approach. Now, the market approach, I've already told you, in order to apply this method of the market approach, there must be a reasonable, frequent exchange of similar assets. There must be a market where there is a frequent exchange of similar assets, or a market where similar assets could be acquired. That is the acquisition market. Or there must be a previous transaction on the asset. Are we together? On the similar asset.
Yes,
If there is a prior transaction on that, you can use that as the basis for the market value approach. Now, the second one is the one that is different, which is the residual value interest. It is the estimated value of the completed property, less all costs that is expected to be incurred to achieve the value. That is the residual interest value. It is the estimated value of the completed property. If you are building a house, you say, okay, what is the estimated value of the completed house? Then we minus all costs that is expected to be incurred. To be incurred to achieve the value. Are we together? So that is residual. It's just the total estimated value to complete the asset, the new property, and then you now less the expected cost, all costs incurred, or is expected to be incurred since the property may have not been developed. If it has been developed, then all costs that are incurred, you less them by. Whatever you have as the difference is what we call the residual approach. These are the two key approaches we use for estimating development property. The last but not the least, I think that should be the last one, IVS 500. Please check for me. Is that the last one? IVS 500. There are many IVS, like I said, but I will only stick to the ones that are examinable at this level, which is IVS 500 financial instrument. Financial instrument. IVS 500 financial instrument. What is a financial instrument? IVS 500 started by the definition of financial instrument. You say, is any contract, financial instrument, is any contract which may give rise to financial assets to one entity and financial liability or equity interest of another entity. So it gives rise to financial assets in one entity, equity interest or financial liability to another entity. We mean financial asset could be a receivable, debt receivable, or even trade receivable, while financial liability, trade payable, and other form of non-current liability or current liability that you know. Equity interest is more on the share capitals of the entity. A valuation actually of financial instrument is an area where it requires a thorough understanding of the instrument that is being valued. If you don't understand what is the instrument, it may be difficult for you to be able to value financial instrument. Financial instrument is categorized, like I said, into financial asset, financial liability, and equity instrument. It's classified financial assets, financial liability, equity instrument, so equity instrument, we may also have like derivatives and the other that may fall part of the financial liability. Are we together?
Yes, sir.
If you don't understand the nature of the financial instrument, it may be difficult for you to evaluate the relevant market information available for that particular either identical asset or comparable instrument. Now, the valuation must take the following into account. Whenever you are valuing a financial instrument, you must take the following into account. Factors to consider. What are the factors to consider when valuing a financial instrument? Number one will be the class or classes of instrument to be valued. Are we together? Number two,
Yes,
is it individual instrument or a portfolio? And number three is the unit of account. So number one is the class of the instrument or classes of the instrument. Number two, is it individual instrument or a portfolio instrument or portfolio? And number three is the unit of account. That is what IVS 500 stated, that consider those three items, take these three items into account when valuing financial instruments. Like I mentioned, the first one is the class or classes of the instrument to be valued. What kind of class are there? Is it a financial asset? Is it a financial liability? Is it an equity instrument? You need to be clear on what kind of asset is it. Number two, is the asset or liability individual or in portfolio? Is it more than one instrument? That means they are in portfolio. And then number three is the unit account. Are we together?
Yes, sir.
Now, the three valuation approaches that are described in the general international valuation standard may be applied to the valuation of financial instruments in any given circumstances. The three of them, you could choose. And what are those three instruments we mentioned, which is the market approach, the earnings approach, the residual value approach, which we have mentioned from the beginning. We have seen three approaches. Abi?
Yes.
So the three approaches, all the three approaches could work. Unlike the others, I think the development property, only two approaches we say could work. Market or residual. Abi?
Yes, sir.
The 210, the 410, sorry. The 210 that is with intangible asset, we only mentioned that it's only the income approach that we work there, because it's difficult to have a market value for intangible asset. You remember that? By the business interest, we mentioned the market approach and the income approach will work for the business interest. Is that clear, sir? That is IBS 200. So the first one is the market approach. I've explained this, so I may not go deep again into it. Although the consideration may be a little bit different here, because a price will be obtained from trading on a liquid exchange, on the exchange, stock exchange market. You could obtain the price directly. Are we together?
Yes.
Now, be careful with this, because when it comes to valuing financial instruments, sometimes we may have a market for it, like forward contract, future contract, options. Most of this has market in some country, like in the UK. There is a market for future, there is a market for option if you want to trade it. Are you with me, sir?
Yes, sir.
So the next approach is here, is the income approach. I've already given some illustration on these particulars. I don't think I need to go over the market and the income approach. I just need to highlight them so that you know these are the approaches that will be used. Number two is the income approach. And then the number three is the residual interest approach. Are we together?
Yes, sir.
So these are the three approaches that could be used or could be used for the asset. Please be careful because the market value on financial instrument is the one that is more commonly used. The first one said that we should use market for identical asset. We should look for market for identical assets or liability, or we can use market for comparable assets, or we can use, if there is no comparable market, then we can use estimation here. Estimation, any of those methods work. Mr. Kayode, this is what I can give you for international valuation standards that you asked me to. Like I said, I can only do a bit of an overview for you to estimate the value. Please don't get it wrong. When you use the market approach to value, especially on quoted equity, if the equity of the company is not quoted. Are we together? Most of the time you can use the dividend they have been paying over time. What we call the dividend valuation model. Dividend valuation model can help you if the company is unquoted company. Are you with me?
Yes, sir.
And then discount it. Discount it. Dividend valuation model can help you if the company is not a quoted company. Then you discount it. That is all that I think you require from me, except there are any other things again you want me to look at, but I will urge you to go and digest this one first. They are not small. Oh, we are together.
Yes, sir.
Okay.
Yes, sir.
If you still want me to look at the overview, merger and acquisition for you, I don't mind, we can continue. I'm not tired. It's just that I think I've given you a lot today.
Yes,
for you to go and digest. Sabi?
Yes, sir. Yes, sir.
Maybe you are
Thank
strong,
you,
you have more questions, I can still sit down and wait. So
yes,
go and read these things, digest
sir.
it, And then if you still think you have challenge with the merger and acquisition, then kindly let me know. I'll be glad to help. You can call me.
Yes,
You
sir.
have my phone number. We are also on WhatsApp together. You can chat me up on WhatsApp, and then we can look at any time that both of us have a free time and do this. The online face-to-face class is very, very useful. It's very easy to follow. I think you can find the convenience at home. You are following the lecture, Abi?
Yes.
And so at home
Yes,
you
sir.
can. So imagine if we are to meet at the office now, we'll be rushing, and that would be a bit of a challenge. Now you can
Yes,
also
sir.
even attend to some visitor and still return to the class, and we go ahead.
Yes, sir. Yes, sir.
So some people were complaining of data. I say, but if you are going to class, you have to buy fuel into your car. I don't know that you get it.
Of course.
You consider that
Yes,
as
sir.
the cost of the data for going to class. You know, we are accountant, no? We look at overhead
Yes.
cost a lot.
Yes, sir.
Mr. Kayode, I wish you all the best. Please,
Yes, sir. Thank you, sir.
please keep safe, and let me hear
Yes,
from
sir.
you before the exam. Okay? Bye bye.